Ladies and gentlemen, if I could get your attention, we're going to begin our program. Thank you. I hope you had an enjoyable lunch. Please join me in welcoming our webcast viewers. My name is Andrew Graham. I'm the president of the Canadian Club of Toronto, and it's my pleasure to be your host. Viewers, thank you for joining us. We work hard to attract speakers who address issues and causes that are important and top of mind, and I think our speech today is a great example of that. Pensions are an issue that we care about deeply, and notwithstanding the fact that for the first time in a long time I was called young around our table at lunch, I think it's an issue that I care about, and I'm sure all of you in the room, regardless of your age, care about as well. As a club, we've worked hard to, I know innovation is going to be or may be a theme of what we hear about today, and I think we talk a lot about as a club. I think with the advent of the internet in the last few decades, many people asked, is there still a place for people to get together over lunch and hear a long-form speech on an issue like pensions? And I think the answer, with all of you voting with your feet, is there absolutely is. And in fact, in an age of Twitter and YouTube and short news clips, I think it's more important than ever, and I think many of us feel the same way, that we're able to get together in person and exchange views with people around the table. So thank you all for being part of that journey with us this year. We're very grateful to the sponsors who generously, I should say, sponsor events like today. We wouldn't be able to do it without them. I'd like to acknowledge today's sponsors. They're EY, represented by Jad Shamali, Scotiabank, represented by Prin Haskins, TD Securities, represented by Alan Pollack, and Tories LLP, represented by Les Wiener. Thank you for your support. I'd also like to acknowledge the youth and young leaders from the New Horizons Career Club, sponsored by Michael Wang, who have joined us today. Where are you in the room today? Over there. Welcome. I'd now like to introduce our speaker for today. Whether you're near or far from retirement, the connection to the Canadian pension plan is part of our collective consciousness. I think many of us ask, how are the contributions managed? And most importantly, is there going to be enough when it's my time to retire? Since its establishment in 1997, the CPPIB has been focused on one clear mandate, and that is to invest CPP fund assets for maximum return without undue risk of loss. For just over 2 years, Mark Machin has been leading the CPP Investment Board and its activities. As President and CEO, he works to ensure that there will be enough pension funds for the retirement of 20 million Canadians. Mark oversees the billion-dollar growth strategy that includes an impressive portfolio valued at $366 billion. I hope that's still true despite the gyrations in the market today, Mark. Ish. Named one of Canada's top 10 CEOs by Glassdoor's 2018 Employers' Choice Awards, Mark has been at the CPPIB for 6 years. He started as the fund's Asia president and then became head of international. And we heard over lunch today that he was in Beijing last week and delivered half of a speech in Mandarin, which I thought was very impressive. And if anyone submits Q&A questions that are on the tough side, he may resort to Mandarin to answer those. We'll see what happens. Earlier in his career, he practiced medicine in the UK, but luckily for Canadians, he traded his stethoscope and lab coat for leadership in the financial sector. Before joining CPPIB, he spent 2 decades at Goldman Sachs, primarily in Asia. As Vice Chairman of Asia ex-Japan, he ran the investment banking division for 6 years. Mark also served on the firm's Asia Management Committee and the firm-wide Capital Committee. For now, as President and CEO of CPPIB, he's focused on delivering healthy returns. We're keen to hear details of his strategy. Mark, it's my pleasure to pass the Canadian Club of Toronto's podium over to you.
Thank you very much, Andrew. I would imagine that the term disruptive innovation is used in boardrooms and executive suites all over the world every day. Since 1995, when the term was first coined by Bauer and Christensen in a Harvard Business Review article, and it was originally used to define sort of narrow marketing process, it's now taken on a very broad meaning covering just about every type of transformational change. And it's abundantly clear that today we are living and operating in a time of disruption. 各位来自新的毕业的大学生，你们好，欢迎你们来加拿大学习和工作，欢迎来今天的午餐会。Now, if you were all wearing your Google Pixel buds and you had live translation enabled, then you would have heard a real-time translation of my not very good Mandarin. And you would have realized that as I was welcoming these recent graduates from the New Horizon Club who have been studying here in Canada and are now working here in Canada. So again, welcome. Today, language itself is being disrupted by live translation, real-time translation. Healthcare has been disrupted. Today, scientists are 3D printing human tissue for medical experimentation. And soon, probably, they'll be able to print human organs. Demographics are a disruptor. The worldwide population of people aged 60 years or older has doubled since 1980 and is expected to double again by 2050. Climate change is a disruptor. The devastating wildfires that we see today in California, and this summer there were an unprecedented number of fires north of the Arctic Circle. These are all examples of the impacts of climate change. Shareholder engagement is a disruptor. Pension funds and institutional investors are starting to ensure that the companies they invest in are operating in more sustainable ways. And we at CPPIB are embracing these types of disruption and a whole range of disruptions. And importantly, we're becoming a disruptor ourselves. And today I'd like to share with you some examples of how we're doing this. Now, we're in a fortunate position at CPPIB in that we can, with some degree of certainty, predict the future contributions to the Canada Pension Plan. And this allows us to invest with a very long-term horizon. We also have the benefit of scale in that we have a reasonably large fund size and it's a growing fund. And these two factors together mean that we can be a highly disciplined and patient investor. We're able to look through short-term volatility and market cycles. But to do this effectively, we also need to understand the large structural changes and shifts that are happening in the world and how they'll fundamentally change the way all of us will live and operate. Without doubt, the first structural change affecting all of us is the acceleration of technological change, whether it's artificial intelligence or machine learning, the explosion in automation, the use of big data, the Internet of Things, the rise of fintech, autonomous vehicles, and so on and so on. And at CPPIB, we have an obligation to analyze how these technologies will impact each sector, how they're going to disrupt industries, and how they're going to impact our investments, both now but in the decades ahead. We're placing large bets, sometimes in the billions of dollars. And so we need to be expert in what I call the implications business, predicting the future so that we can benefit from its growth and profit from it for the benefit of Canada's millions of pensioners. You don't need to look very far to see massive future changes. A few years ago, the idea of autonomous vehicles was spoken of in a futuristic way. People would say, someday there will be driverless cars. In fact, that day is coming really, really soon. Any day now, Waymo will commercially launch autonomous taxis in Arizona. And by 2020, Uber is planning to launch a fleet of airborne taxis in Dallas, Los Angeles, and Dubai. And our job is not just to understand the exciting aspects about those autonomous vehicles and the autonomous transport. It's also to understand the implications throughout the value chain, whether it's managing fleets of trucks, electric vehicle production, component manufacturers, charging, toll roads, gas stations, the insurance industry, et cetera. We need to understand the impacts on all of those and more. An example of a developing company in our portfolio today is Zoox. Zoox is an autonomous vehicle company based in California. It's aiming to have a fleet of specially designed robo-taxis on the road by 2020. Another company we're partnered with that's been disrupting the financial services industry is Square Capital. Square is a subsidiary of Square Inc., the payments processing company. And Square Capital invests in small business loans in the US, and it uses machine learning to trawl through the vast amounts of data they have so that they can extend the right loan in the right amount at the right time to the right small business. And here in Toronto, we were pleased to announce just a few weeks ago a partnership with Creative Destruction Lab at the University of Toronto's Rotman School of Management. Our CDL, as many of you will know, is a seed stage program that's been widely praised as one of the best in the world at bringing together science-based ventures with serial entrepreneurs, with angel investors, with venture capitalists, with a goal of building massively scalable companies. And we're thrilled to be partnering with them to help inform our view of emerging technologies in artificial intelligence and also in the energy sector. The next disruptive change I'll touch on is the aging population. We're all living longer. We're all living a lot longer. 2 years ago, Canadian seniors outnumbered children for the first time in Canada's history. A quarter of China's population will be over 60 by 2030. And if you're a baby girl born in Tokyo today, your chances of living to be 100 years old are 1 in 2. And these demographic shifts are causing profound economic, social, health, and political change. Some of that change is good, some of it is bad. But we need to understand the implications and the opportunities from these trends. This demographic shift is one of the reasons why we invested in Orpea in Europe, which is one of the leading managed care, long-term care companies in Europe, and provides care for 82,000 people in 800 facilities. It's also why we invested in Viking Cruises. Viking Cruises operates 60 cruise vessels in many rivers and oceans worldwide. As the North American baby boomer generation ages and retires, they have an increasing desire to travel and see the world, and Viking Cruises has been a major beneficiary of that trend. Another significant global change we see is the shift in the economic center of gravity from North America and Europe towards Asia. By 2030, Asia is expected to account for 50% of global GDP, and China alone will represent 23% of global GDP. Now, before I moved to Canada 2.5 years ago, I lived in Hong Kong and Beijing for 22 years, and I witnessed the extraordinary change that happened in China and across the region. And that change continues today. The disruption and innovation and adoption continues today. I was telling some people a few weeks ago, I was in Beijing, and I went into a coffee shop to buy coffee, and I tried to hand over my cash, and I was literally met with laughter from the shop assistants. They thought it was amazing that someone was coming in trying to use cash to buy coffee, and they had no cash in the cash register. There was nobody in the coffee shop had cash, and there was just great hilarity about the fact this strange foreigner was still using this ancient payment methodology and not using his mobile phone to pay. Because China's rapidly moved to a cashless society. Everybody uses their mobile phone. In fact, mobile payments, even 2 years ago in China, was over $13 trillion compared to the US, which is $50 billion. Now, at CPPIB, we've been invested in China for about 10 years, and we've increased our investment there steadily over that time period. We have about 8% of the portfolio invested in China today. Probably our best-known investment is in Alibaba, which we invested in back in 2011. And we did that because we saw the rising power of consumption in the middle class in China, and also this rapid adoption of mobile technology. And so we thought it would be a good investment, and it's proved to be a terrific investment, and we've continued to add to our position, and it's continued to perform. Less well-known probably, but in some ways equally promising, is our partnership with Longfor, the Longfor Group. Longfor is a residential and retail mall developer. It has projects in a number of cities, including Suzhou, Chengdu, Shanghai, Chongqing. And this summer, we initiated a new program with them. We co-invested in a program to provide rental housing. And there's huge demand in China for modern, quality rental housing for young professionals and new graduates. Probably the table over here, if they go back to China, will be using some of these properties, I hope. So through this collaboration, we have an opportunity to participate in this rapid growing new sector in the Chinese real estate industry. Now, we're also embracing the opportunities created by climate change disruption. We started thinking about the risk that climate change would present to our portfolio back in 2008. And we're proud to have been amongst the leaders who've in encouraging companies to improve the way they disclose their exposure to climate change risk factors. Last year, we established our standalone power and renewables investment group, which is tasked to expand our portfolio of renewable energy investments. And within that, we're tracking a number of aspects, including power generation, energy storage systems, smart meters, and other related technologies. Some of our investments in renewables include a joint venture in Brazil with Votorantim Energia, where we operate wind farms in the north of Brazil and now in hydropower. And in India, we're an investor in Renew Power, which is a leading developer of wind and solar power production. And closer to home, we've invested about $3 billion here in Canada in a number of wind and solar projects with Cordelio Power and with Enbridge. So all of these are examples of how we've been embracing disruption, whether that disruption is technological, whether it's demographic or economic or climate change related. Our job is to find the best opportunities and invest in them for the long term. And we do this also by incorporating a disciplined, multidimensional risk management framework. As I said earlier, we're also becoming disruptors ourselves. We believe that by actively engaging with companies that we invest in, we can help disrupt the status quo and initiate meaningful change. And we've identified 5 specific areas where we will be a disruptor: climate change, water conservation, human rights, executive compensation, and board effectiveness. If the companies we're invested in are not operating at the standards that we think they should be, then we engage with them directly to influence positive change. Now, from time to time, we, like many investors, are challenged by people who put pressure on us to divest if they disagree with the policies or actions of a company we're invested in. We think divestment achieves little for CPPIB and our stakeholders. There's a large supply of other capital, both public and private, that will step in if we exit. And in fact, we believe the opposite. We believe that by staying in and being a positive force for change, we can truly make the market and the world a better place. The best way to influence corporate behavior is through principled, constructive, and collaborative engagement. And we think the results are clear. It works. And encouraging companies to take a constructive approach to their environmental, social, and governance issues also makes them more likely to create sustainable value over time. So let me share a few examples of how we've been doing this. Over the years, we have monitored and encouraged the work being done by oil and gas and mining companies on key performance indicators with relation to water conservation. In fact, the World Economic Forum has consistently identified water supply crises as a likely trigger of major global risk. And CPPIB was one of the first signatories of the launch of the CDP water program in 2010. And this year, we collaborated with 35 other global investors on creating collaborative engagement with companies on water risk in agricultural supply chains. In 2016, we filed climate change-related proposals at 2 global mining companies that received support of more than 90% of the other shareholders. And our positive intervention caused those companies to change their practices. Since 2016, we've worked with 20 global investors in collaborative engagement with relation to child labor, human rights, and poor safety conditions in the cobalt industry in the Democratic Republic of Congo, which is the world's largest producer of cobalt. And closer to home here in Canada, in this past year, we voted at 45 shareholder meetings of companies that had no female directors on the board, not one female director. And we're pleased to say that since we voted, 21 of those companies have added a female director to their boards, which is a good start, but clearly more work to be done. So, thank you. Now, we're going to continue to monitor the representation of women directors on the boards of all of our companies, and we now plan to roll this program out globally. Whether we're embracing disruption or becoming a disruptor ourselves, our most important obligation is to deliver solid financial results over the long term. And we never lose sight of the most important reality of all, is that we're working on behalf of 20 million Canadians. Strong long-term financial performance is what will ensure the fund is sustainable for many generations to come. As of September this year, our last reporting period, our 10-year and 5-year annualized returns were 9.1% and 12.1%. And these returns are significantly above what the chief actuary assumes in his 75-year projections. So as we approach our 20th year anniversary, we've grown to be one of the larger pension funds in the world. Most importantly, we aim to be one of the best managed pension funds in the world. And we'll do this through turning the forces of technological, economic, social, and environmental change into opportunities for sound investment. I know all of you and 20 million other Canadians are counting on us to do just that. Thank you.
That's perfect. I'll give you that one.
Okay, thank you.
Well, thank you so much for those thoughtful, very, very thoughtful remarks and very helpful remarks. And we'll have a more formal thank you at the end of this. But first, we've got some great questions, I think, from the audience. To start off, can you talk about the challenges between having such a long time horizon? You talked about sort of a 75-year time horizon when you make investments, and the increasing pressure on short-term results and quarterly reporting and so forth. Is there a tension there? How do you talk to management teams about how to bridge that gap?
Yeah, it's an important topic and one that we identified several years ago. A number of you will know, in fact, Alison Lote is here from the organization called Focusing Capital on Long Term, or FCLT Global. And we initially set that up with McKinsey and Dow and BlackRock and Tata as an organization to try and move practices in the world from very short-term behavior towards long-term value creation. And there's lots of research to show that there'd be substantially greater value created for economies and for companies if they focused on the long term. And the shocking thing was, in repeated surveys, Most CFOs or CEOs would say they would not invest in a project that was long-term value creative if it meant they missed their next quarter's earnings results by 1 cent, which is just crazy. So we as long-term investors want to see long-term value creation. Long-term value creation creates the value for pensioners. We don't care about the next quarter. So this is one of the initiatives that we've used to work with other like-minded investors, and there's a very large number of people who've now joined this initiative to try and influence positive change and move people towards a more long-term mindset.
And just following on from that, and you talked about other ways you can influence boards and other priorities. How does executive compensation factor into that? What do you think is a sort of a best practice approach now?
Yeah, so I think on executive compensation, we want people to have their pay linked to performance. So we appreciate people being paid for performance, but if the pay is not linked suitably to performance, then that's something we really don't like. So we want people to have a responsible level of compensation, but it not to be just locked in no matter what. We want to see it driven by how people will perform over time.
Shifting gears a little bit, do you see CPPIB having an obligation to make infrastructure or to support infrastructure investments in Canada? And the person who wrote this referred to the Caisse de dépôt in Quebec supporting, for example, commuter infrastructure in Montreal. Yeah,
so our mandate's really simple. It's one of the things that was sort of the genius of CPPIB and how it was set up in the 1990s. And there were a number of things that were genius about it, but one was, and it's the envy of the world, the governance set up of CPPIB. It's just, it was brilliant. But a number of things. One is that we are arm's length from governments, so we are accountable to, but we're arm's length. So there can be no political interference in the investment decisions that we make. And the second thing is the mandate that we're given as for the board and management team to interpret is very simple, which is to maximize returns without undue risk of loss. And so there's nothing in there about doing things to help the economy of a particular province or help the economy of the country. It's purely about maximizing the returns without undue risk for this pool of capital. So it's up to us to figure out what's the best way of doing that, where to invest in the world, how to invest, which strategies, et cetera, that we think as investment professionals can result in the best long-term returns. And that's a hard enough job in itself, frankly, to do that without putting on other requirements on top of that. And we see many examples of institutions like us around the world where there are other requirements laid on top. And it makes the job much more difficult, much more challenging. It's hard enough just to make money in the long term without trying to take other things into account. So that's the way the mandate's set up right now. So everything we look at through those lenses of maximizing returns without undue risk. So we look at the returns and the risk metric for everything we do. And we'll do the same for investment in Canada and infrastructure. So we will look at every single major investment opportunity. We have an obligation to do that, to look at every single major investment opportunity and decide, are we going to make sufficient returns on it relative to the other opportunities we can and relative to the risks in that investment. That's the way we look at things. So that's the way we're set up today. Would that ever change? The governments always have the right to go back and rewrite legislation and change stuff, but I don't. That will be up to the Canadian people at some point if they ever wanted to do that. But today, I think it's set up in a way that is, I say, the envy of the world.
So you talked about keeping trends like global warming in mind, or climate change in mind, I should say, when you're making investment decisions. So that's really from the perspective of what's going to deliver returns versus a political lens. Is that right?
Yeah, that's correct. And that's what makes these environmental, social, and governance concerns very, very aligned with long-term returns. So there may be a cost in dealing with it in the shorter term, but when you look through a long-term lens, it's very, very aligned to benefits for long-term return. So we look at climate change risk as one we believe absolutely that climate change is happening. So we believe it's a risk. We believe it's a complicated risk that's multifaceted, whether it's geographic change or consumer behavior change or regulatory change, et cetera, et cetera. There's many, many aspects to how that is going to change how our investments will perform. And we want to be able to be on the front foot and take advantage of the opportunities that will emerge from that. But we're looking at everything, again, through that risk-return lens. But to understand the risks that are involved is complicated, and nobody's cracked this. So I mentioned in the speech briefly, we've been part of an initiative to improve the disclosure of risk factors in financial statements. There were already, I think, about 800 other initiatives that have been implemented or people had been developed for disclosure of climate risk. But this one that we worked on with the Financial Stability Board was one that I think we hope is going to be, the gold standard for disclosure. And until you have all that disclosure, it's very, very difficult for us to roll up into our portfolio when we have thousands of securities in there. It's very difficult for us to understand what we have in the portfolio in terms of climate risk. So by improving disclosure, we can understand much, much better what we have in the portfolio.
I'd love to take advantage of some of your experience with Asia. Can you talk more about China, and in particular, whether you see risks from growing rivalry between the U.S. and China, perhaps some of the complexities of China's internal political situation as well? How should we think about that?
Well, it is one of my biggest concerns in the world today is this growing tension between the U.S. and China, because I don't think it's just about trade. I tell people, I remember I was at a dinner in China about 8 years ago, and I said to my fellow guests that I was concerned that when China's economy got to being close to the US's economy, that the US's psychology would become quite concerned and anxious. And my guest said, no, it won't happen. But I feel sort of vindicated today, because that's one of the fundamental things that's happening here. And when you read Mike Pence's speech, or just the continued commentary from the US, there is increasing concern about the strategic threat that China poses just by being bigger. And that's a real worry. I hope that there's a way of getting through this, and I hope that the two countries can work together in a better collaborative way, because if that happens, then it's a benefit to the whole world, and the whole world's benefited in the last 20 years from that collaboration, that free trade, and the peace and prosperity in the world over that time period. I think if things get more tense, and there is, in Hank Paulson's word, this economic iron curtain that comes down, then that's not good for anybody in the world. There may be some small beneficiaries. Vietnam may be a beneficiary from supply chains moving to Vietnam, or Bangladesh, whatever. So there's always going to be someone who's going to benefit somewhere on a relative basis. But I think the whole world's economic growth potential will suffer. And so the US is going to have to think very carefully about how to manage the strategic threat as they see it in a way that doesn't cause a big risk for the overall global economy.
I think you certainly addressed many aspects of the next question. In the context of a potential U.S.-China trade war, are there opportunities? And you mentioned perhaps Bangladesh or Vietnam. Are there other? I was really taken in your remarks how you talked about climate change, and that it throws up a bunch of opportunities, and other big changes in the world throw up opportunities. Are there any other sort of big macro opportunities that either a rising China or resistance to a rising China throws up?
I mean, there'll always be opportunities everywhere. One of the things that I think we'll find is that there's going to be increased stress in some of these markets that are directly correlated with Chinese manufacturing and export growth. And it will probably throw up interesting investment opportunities where companies are starved for capital, where there's indiscriminate selling across markets. And it's something about what we've seen recently, where all markets are down, emerging markets are down. There's general concern. If you're a sort of part-time investor in China or part-time investor in Asia, you probably don't want to go through the hassle of figuring out what is going to outperform on a relative basis. So there's a lot of indiscriminate selling that goes on. At the same time, there's occasionally policy mistakes. In the first half of this year, I'd say that China had a number of policy mistakes which unintentionally squeezed the private sector in China. So they did two things, for example. One was they tried to start deleveraging the economy, which makes sense, depending on how you count. Leverage in China is 260+% of the economy. They knew it's unsustainably high over time. They'd like to reduce it, so they started reducing it. At the same time, they also started controlling shadow banking, which, again, has been widely talked about. So they started shrinking the shadow banking. The consequence was that the banks decided, well, if we're going to be restricted on where we lend, we'll just lend to the state-owned enterprises because that's safe. We'll never get in trouble by doing that. And the private companies who used to go to the shadow banks to get money when they couldn't get it from the banks, they go to the shadow banks, and the shadow banks says, sorry, we've been squeezed. We're closing down our capacity. So the private sector in China at the middle of this year was in real trouble from a credit provision point of view, and it was really dangerously squeezed. And then the tariffs happened on top of that. It couldn't have happened at a worse time. But that wasn't deliberate policy to squeeze the private sector. It was sort of an unintended consequence of the combination of sort of very, very efficient implementation of two, or efficient and clumsy implementation of two major policies. So that, for example, then threw up lots of opportunities in the private sector where they're starved of capital and they needed capital urgently from a number of places.
Okay, shifting gears here a little bit. What is your long-term view on Bitcoin and other cryptocurrencies?
It's not a good day today, no? But I think, again, I'm a believer in blockchain and distributed trust and the applications of the blockchain technology. So that's I think something that we can all probably agree on. And we participated in a number of initiatives, the settlement of equity derivatives. We participated in an industry-wide blockchain initiative, and we're exploring other ways of using blockchain. Cryptocurrency, the challenge with cryptocurrencies themselves is, do they really do the two things that currencies are meant to do? One, store of value, and secondly, be an efficient payment mechanism. And at the moment, there's no cryptocurrency, I think, that is demonstrating those two areas. So for us as an institutional investor to step in and start buying and putting that as responsibly as part of a portfolio, we'd have to see some emergence of those characteristics in one of these cryptocurrencies. And it's possible that there's lots of ways that people are trying to improve the efficiency of these currencies and the energy consumption from these currencies. But I think it's a way down the road.
Thanks. We only have time for a couple more. You talked a lot about disruption in different industries being disrupted. You're part, in a sense, of an industry, asset management, where there's been certainly lots of talk of disruption, perhaps not a huge amount of disruption yet. Interested to hear your views on asset management as an industry and what the future holds.
Yeah, that is a good question. I don't know whether I have a fantastic view on it, to be honest. I think we've had this huge swing towards ETFs and passive management over the last several years, and that looks to be continuing. I think there's, private banking and private wealth management is ripe for disruption. I think the efficiency and effectiveness of the access that most individuals get to asset management is not that great. And fees are very, very high, and the sort of sophistication of what you can get is not that high. So there's huge disruption, I think, that fintech can provide to improve what individuals have access to. In terms of institutional asset management, I was talking with a colleague earlier, and I'm going to ask a slightly different question, but one of the risks in the world is the huge move to illiquid investments and so-called alternative investments. And institutions like us, but there are thousands around the world, have moved towards a very large proportion of relatively illiquid and very complicated investments, come the next downturn, a couple of things, well, 2 or 3 things will happen. One is that those institutions will probably end up being forced sellers of a lot of their liquid assets because they're going to be stuck with a lot of illiquid. And then a second thing is that the embedded leverage, and leverage is always the killer for in most downturns, the embedded leverage in a lot of these things is getting higher and higher as people are putting leverage not just at a project level, asset level, putting it at a fund level and back leverage, and before they know it, there'll be enormous layers of leverage on some of these investments that they haven't really understood, and that will just compound the issue and could cause a forced selling of liquid investments that, so you could see risk models get quite disrupted by things that should be liquid and shouldn't sell off so much, but because everybody's got so much illiquid, it will get disproportionately sold off. That's one scenario.
Maybe just a last question here, which maybe brings us back to the importance. We've been talking at a very high level about some of these macro trends, but this brings us back to really the importance of the CPP. As a younger person, my parents and my friends' parents are retiring. With more people retiring or already retired, how can we have confidence that there'll be a CPP for future generations to rely on?
Yeah, and so I generally say, don't just believe me, believe the chief actuary. And I think that's one of the secrets and one of the strengths of the Canada Pension Plan since it was started in 1966, was this requirement for the chief actuary to come in every 3 years and say, is it sustainable? For him to do his independent work, to look at demographics, to look at employment trends, to look at economic trends, to look at all the other factors, longevity, birth rates, et cetera, put all that in and say, is the fund sustainable based on the current contribution rates and benefit rates? And so he's done that every 3 years, and sometimes more frequently, since 1966. And I think we all know that in the 1990s, he wrote that report saying, guys, if you carry on like this, there'll be nothing left in the fund by 2015, so you have to do something, you have to change. And a number of things changed in that they increased the contribution rates, they reduced the benefits, and then they created us to invest the money in a way that over time would create a higher return on the fund. And that's worked pretty well for the last 19 years. So the chief actuary continues to come in. He's coming in again. He's writing his reports right now. And in fact, he wrote a couple around the fact when the CPP was enhanced, again confirming yet again that the fund is sustainable over a 75-year period. But that's the report to read and understand. And his expectation when he does that is we're going to make over a 75-year period something around 3.9% over inflation over that time period. And I gave the returns earlier on a nominal basis, but they're substantially above that for the last 5 and 10 years. But that's what we need to keep an eye on.
Great, thank you.
Very good, thank you.
Mark, on behalf of the Canadian Club of Toronto and everyone in this room, I really want to thank you for coming to speak today. I was struck by a couple of things. First of all, by how important your job is, and I think the last question was a good reminder of that. There's, in case you didn't already feel the pressure, there's literally millions of people counting on you and your team to make sure that there's a pension plan there for all of us when we retire. So I was struck by that. I was also struck by how complex your job is. You've got to, in the same breath, worry about climate change and diversity on boards and what's happening in Asia and analyzing whether there should be investments in cryptocurrency. There's a lot going on in the world, and you sit in an important chair and have to worry about a lot of things. So thank you very much for taking the time today to be with us and for sharing your thoughts on these and other matters. Just before we conclude, let me give you some highlights of some upcoming events. This Friday, we have the Honourable Bill Morneau, Federal Minister of Finance, coming to speak at our podium to share his fall economic statement. And Thursday, December 13th, we have Ed Clark of the Vector Institute. He'll be our special guest speaking about the AI ecosystem in Canada. Another great event on the theme of disruption. Before we close, allow me to thank today's event sponsors again, EY, Scotiabank, TD Securities, and Tories. Thank you. We'd also like to thank MediaEvents.ca, Canada's online event space, and VVC for live streaming the event. And thanks to all of you for attending. Hope to see you again soon.